Mean reversion is a pretty interesting concept when it comes to trading, and this is when prices move away from an average price. They often tend to return towards that average price. So when you spot a large move in one direction and you've designed a mean reversion trading strategy, you can use this knowledge to help guide your trading as you expect a reversal to set up. The moment of imbalance between momentum and mean reversion is the ideal opportunity for exiting the market, since we'll likely see a start of a trading range pretty soon. So what is mean reversion? It's actually a statistical phenomenon. It's where we see excessively high or low prices pulling back. And we really observe that in markets that experience short-term fluctuations or momentum price movements. And these movements can be driven by a variety of factors, including trader sentiment. So when traders become excessively bullish or bearish about an asset, it can create a ripple effect in the market and cause prices to move away from the average. Supply and demand. And that's just when we see changes in that. So for example, if there are large available shares of stock and there's not a whole lot of buyers, prices may temporarily drop below the average value, but eventually return back to the average value as demand catches up to the lower prices. We can see it with market shocks, and that's when we see unexpected news events or changes in government policies. These can cause temporary price movements that will eventually, again, revert to the mean. Now, technical indicators, we can use that, and we can identify the mean reversion using them. We can use Bollinger Bands, Keltner channels, RSI. These can help identify an oversold or overbought condition. So you understand the underlying causes of mean reversion. You can actually develop a pretty effective trading strategy that takes advantage of this price movement. And remember, when these two forces are in balance, mean reversion and momentum, we will see a trading range. And if you've been chopped up in an instrument, who hasn't been? That's equilibrium. So we want to know how painful that can be and make sure that we don't get stuck in that. Now, mean reversion, we don't want to confuse that with a true change in trend. So after we see a momentum move in price, it's common to see some degree of overextension. So this can be seen as the market attempting to go too far and subsequently being faced with increasing resistance or decreased demand. Now, the result of the overextension is often a mean reversion, and it pulls the market away from that established trend direction. Now, it does not always equal a change in the long-term trend. That period of price correction can often help create stability for the future movement of the instrument. Lower prices in an uptrend, they attract fresh buyers, new positions. So this chart here has a 48% increase in price with momentum over 13 trading days. With such a long run up and no down days, it's actually a prime candidate for mean reversion. We see a complex correction shape up. Price begins to chop around the 20-day simple moving average. That's just the average price of the last 20 sessions. Momentum steps in again, and the price was currently up 38%. Now this overall trend, though, that remains intact. Price continues to make higher highs. It's a daily chart of Apple, shows momentum to the upside and then mean reversion. So even though we understand that market prices will naturally revert, it can be hard to precisely predict when or what the average price may be. And there are many tools that we can use for that to make an educated guess about the target and when it will happen. But ultimately, it's still a guess. But knowing the price is not really the point, because we're not really looking for home run hits when we trade against the trend with our reversion to the mean strategy. So a common pitfall, and listen, while it's true that mean reversion is a force in the market, a market that went up or down on momentum can work off that overextension in other ways. So when prices lose momentum, it'll often either fall into a trading range or form a bull flag continuation pattern. That's for prices that were in an uptrend. Now, those are the two most common ways that price will work off that momentum. So on the left, that price mean reverts more than half of that 45% increase in price. On the right, we see a bull flag. And with that last one, we see a trading range form. So the takeaway is that you don't blindly just trade potential mean reversion just because the market had momentum. You need to see some type of reversal setting up to increase those odds. So here's a tip. One of the key challenges is determining when an instrument is overextended and likely to revert. This requires analyzing various indicators, including moving averages and bands or channels. So one common approach is just to look at the distance between the price and a moving average, which can help identify when an instrument is potentially overextended. Well, the question then becomes, how far must the price move before we can say it's overextended? This is where bands or channels come in handy. Bollinger Bands, pretty popular method, and these are created by adding or subtracting a certain number of standard deviations, generally 2, from an average price. So this indicates that the price may be overbought or oversold and ready for mean reversion. So when the price of an instrument reaches a certain distance from the Bollinger Bands, traders will look for a setup to position against, so they can go to the downside because this suggests that the market's overextended and due for a mean reversion. This might involve looking for a reversal pattern, like a double top or a head and shoulders, or just waiting for price to move back towards the moving average before entering a position. You just got to pick one. The key to successful mean reversion trading is really to carefully analyze indicators and price and just determine when an instrument is overextended and likely to revert. These Bollinger Bands, we wait for reversal setup to develop, then you can improve the chance of success and generate some profits on these moves to the downside. So if a price of an instrument is poking outside of either the upper or the lower band, it could indicate a potential mean reversion trade, but it's important to exercise caution because just shorting or going long based on this signal alone can be risky. Instead, wait for a clear setup to emerge before you look at a position, and this could be a reversal chart pattern, and again, double top, double bottom, head and shoulders, doesn't matter, or even a single reversal candle. Keltner channels, my favorite. I'm not a fan of the balloon effect of the Bollinger Bands. I like the ATR feature of the Keltner, and this is a 20 period channel set to a multiplier of 2.5. You would treat the excursion beyond the channels the exact same way you would with the Bollinger or any other band. Let's talk about mean reversion setup. So once you've identified an overextended instrument that's increased on momentum, now we may have a setup, but this is not enough of a condition, right? We need an actual setup. So there's a few ways to look at trading this move, and one of them is the simple 2B price pattern. So the first step in our mean reversion trading strategy is just look for price to run up, break the upper Keltner. This suggests overextended. This stock price had run up 62%. It broke the upper channel line. We can consider this as the first part of our setup. We have a small retracement, price breaks the high, and then a reversal candlestick takes place. You would place your sell stop to enter short below the reversal candle. But if price reverses and continues in the trend direction, we gotta get out. So our protective stop loss just beyond the high of that reversal. Another example, this is a reversal candle. It's a bearish engulfing one. The trade entry and protective stop loss is the exact same that we just talked about. So if you want to see an ideal setup for a mean reversion trade, this would be it right here. So typically at the end of a move, the price of an instrument is going to run up with momentum, break through channels. Following this, we like to see a slight pullback that results in a new candle low. The price continues to rise again slightly, takes out the most recent highs, but then collapses. And there's other ways to trade overextended instruments, right? But the 2B failure test setups, probably one of the better ones. You know, so if we consider what price is showing us, price rises, breaks the channels, right? Traders are on the sidelines. They're suffering FOMO, the fear of missing out, from missing that first move. A slight retracement takes place. That's going to bring new buyers into the instrument. Price makes a new high. Now it brings in breakout traders into that. Now they think a new trend's starting. A quick reversal has the longs exiting their trades. Those that trade at mean reversion are quickly in profit. Let's talk about risk management. With these trades, often the best course of action is to reduce the position size, since they are against a larger trend. So by taking half of your position size, what you usually trade, you can actually better manage any possible losses if that triggered trade does not play out. Now, since different time frames are reacting differently to this price action, there actually may be a second opportunity above or below whatever your original trade was. So this would provide you an opportunity to get back into the trade. Let's wrap this up here. I think mean reversion can be profitable if you're looking to take advantage of short-term price movements. When you carefully analyze price and indicators and waiting for clear setups, having a mean reversion strategy can increase your chances of success in getting these trades. Risk management is really key because you are trading against the prevailing trend and you should really adjust your position size. Also, false signals are pretty common with mean reversion trading. So it's really important to have a good understanding of indicators like moving averages and price action for the higher probability trades. Look for that perfect setup as we described earlier. I think it's a great tool. I want to consider checking that out. And also, when you're checking something else out, off to the left here is our price action strategy. It's a free PDF you can download. The link is to the left or in the description below. I want to grab that before we stop giving that one away. All right, talk to you soon.